So in this lecture we're going to look at some further aspects of partnership accounting, namely what happens if we have a change in the number of partners. So again, your reading for this lecture is from your Thomas & Ward textbook, chapter 25 and 26. So first of all we're going to deal with the admission of a new partner. So when a new partner is admitted to the partnership or joins the partnership, then the partners will agree a certain sum of cash that the new partner must pay for his share in the partnership. Basic double entry for the cash that the new partner brings into the partnership is to debit the bank account and credit the new partner's capital account. However, there is a complication in that we need to consider the goodwill of the partnership. So what is goodwill then? So as well as the net assets that the partnership have recorded in their ledger accounts, such as machinery, motor vehicles, etc., most businesses will have another asset which is not recorded in the ledger accounts, namely goodwill. Goodwill comes about due to the excellence or reputation of the business. It can be due to good quality products, good after-sales service, good location, excellence of the employees, and many other factors. The problem with goodwill is that it's not only very difficult to measure in monetary terms, but it is also very volatile, very changeable. Goodwill is essentially the value of the business as a whole and above the value of the recorded net assets. Unless the business is actually being sold, then this total value is only an estimate. A further problem is the nature of goodwill. Suppose that goodwill of a restaurant business has been built up due to the reputation of the head chef. If that chef leaves, or there is a bout of food poisoning in the restaurant, the goodwill is wiped out immediately. Due to these problems, such goodwill is not recognised in the financial statements of a business. However, there's little doubt that it actually does exist in many businesses. So when a new partner is admitted to the partnership, he will be buying not only a share of the recorded net assets of the business, but also a share of this unrecorded goodwill in the business. And this must be recognised in the accounting procedures. So we have a three-step approach that we need to follow in order to bring in a new partner. So step one, immediately before the admission of the new partner, the amount of goodwill that the old partners have built up must be recognised and shared out between the partners. This is done following the double entry. So we're going to debit goodwill account with the estimated value of the goodwill as an asset, and we're going to credit the old partners' capital accounts in their share of the old profit sharing ratio. In step 2, so the new partner will now be admitted and the cash that he brings into the partnership is accounted for by debiting the bank account and crediting the new partner's capital account. And then finally, the goodwill must be then eliminated from the books, and this is done by debiting all of the new partner's capital accounts in the new profit share ratio and crediting goodwill with the value of the goodwill to reduce the account back to zero. So let's look at an illustration dealing with the admission of a new partner. So Pete and Paul have been in partnership for a number of years and they've been sharing profits equally. The balance on Pete's capital account is 100,000 and the balance on Paul's capital account is 80,000. They've decided to admit a new partner into the partnership, Phil. Phil's going to contribute 60,000 in cash into the partnership on his admission, and the profit share ratio after he is admitted will be 2/5 of the profit for Pete and Paul and 1/5 of the profits to Phil. Goodwill in the partnership is estimated to be 30,000. So we've been asked to write up the partners' capital accounts to reflect the admission of Phil. So remember step 1. So we're going to establish the entries for the creation of goodwill. So first of all, we're going to need a goodwill ledger account. So as this is an asset, to increase the asset will be a debit. So a debit of 30,000, and the opposite entry will be to the capital accounts. So remember, it's brought in terms of a share of the existing profit share ratio. So for the capital accounts, we're going to have one for Pete, one for Paul, and so they've got currently a balance brought down on their capital accounts. So Pete has 100,000, Paul has 80,000, and for the goodwill entry, remember that they currently share profits equally. So of the 30,000 goodwill, Pete is going to receive 15,000 and Paul 15,000. So that's got our goodwill into the accounts. So the next step then is to introduce our new partner. We're going to bring in Phil. Okay, so in terms of Phil's entries then, so again looking at the capital accounts, we're going to have Phil, Paul, Pete, Phil, Paul, Pete. And so far on the capital accounts we have balance brought down for each of Pete and Paul, so 100,000 and 80,000. We have the goodwill figure for the existing partners, Pete and Paul, of 15,000 each. And then finally Phil is going to bring some money into the partnership, and he's bringing in 60,000. So that's got filled into the accounts. So the third step then is we now need to eliminate the goodwill. And this is in the new profit share ratio. So in terms of our goodwill account, so the creation to the capital account was a 30,000, and the opposite entries went into the capital accounts of the existing shareholders, partners. So we have a balance brought down of 100,000, 80,000, goodwill creation of 15 for each of the existing partners. Phil brought 60,000 in cash, so that's the position we're at. So now we need to eliminate the goodwill, so we're going to get rid of it. So reduce the goodwill down to 0, so we're going to credit the goodwill account with 30,000, and the opposite entry will go to the capital accounts in the new profit share ratio. So for Phil, Paul and Pete, the goodwill will be eliminated according to the new share ratio of 2/5, 2/5 and 1/5. So Pete will get 12,000, Paul will also get 12,000, and Phil 6,000. So effectively what Phil has done, Phil has actually paid the existing two partners for his share of not only the business but also for the goodwill that they built up. So now if we total up the accounts, so Phil will equal 60,000 and we'll have a balance to carry down of 54. Paul has 95,000. With a balance to carry down of 83,000. And finally Pete 115,000 with a balance of 103,000. So reflecting the fact that Pete's and Paul's original capital balances, the 100,000 and the 80,000, has gone up by the £3,000 each, so the £6,000 that Phil has paid in order to join the business in terms of the goodwill. So now looking at the retirement of a partner. So when a partner retires from the partnership, the full amounts that are due to him must be calculated. This will include his capital account balance and his current account balance, plus his share of any goodwill that the partnership has at the retirement date. The adjustments in the partner's capital accounts reflect all of this are very similar to those that we've just dealt with for the admission of a new partner. So for our accounting adjustments then, so on the retirement of the partner, there's a number of accounting adjustments that must take place to ensure the full amounts due to the retiring partner are paid to them. So step 1, transfer the retiring partner's current account balance to his capital account so that we're only dealing with one account. So debit the partner's current account, credit the capital account. This is normal way round, provided that the current account had a credit balance at the end. So in terms of step 2, recognise the goodwill that's been built up in the partnership by temporarily setting up a goodwill account and crediting all of the partners their share of goodwill. So we'll debit the goodwill asset account to create the goodwill, and we will credit the partners' capital accounts in their profit sharing ratio. Now the retiring partner has the total balance that's due to him in one account, his capital account. It must then be effectively paid off, settled up. The simplest method to pay him what is due is in cash, so we'll debit the retiring partner's capital account with the balance that's due and credit the bank account. However, there are circumstances in which the partnership may not have enough cash to pay off all that is due to the partner, so instead the retiring partner may leave some or all of what's due back to him as a loan to the partnership that will be eventually repaid in the future. So in this case we will debit the retiring partner's capital account to clear it and then credit a loan account. The final step then is we must now remove the goodwill from the ledger. So we're going to debit the remaining partners' capital accounts in the new profit sharing ratio and credit the goodwill account with the value of the goodwill to reduce it to 0. So having a look at an illustrative question then. So 3 partners, Rob, Mark and Di, have been in partnership for a number of years and they have been sharing the profits in the ratio of 3, 2 and 1. On the 31st of March 2017, Rob retired from the partnership, and at that date we've got goodwill that was valued at 60,000. The other 2 partners agreed with Rob that he would be paid 20,000 of what was due to him in cash, and the remainder would be set up as a loan to the partnership. So after Rob's retirement, Mark and Di are going to share the profits in the ratio of 2 to 1. So we then have some information on the capital and current account balances at the 1st of March 2017. So capital accounts, so Rob has 65,000, Mark 55,000 and Di has 40,000. In terms of their current accounts, Rob has 8,000, Mark has 5,000 and Di has 2,000. And in the absence of any other information, the assumption is that these will all be credit balances. So we are required then to draw up the partners' capital accounts to reflect the retirement of Rob. So there's 3 accounts that we're going to be using in this question. So we need a goodwill account, we are also going to need a capital account for each of the partners. So we're going to have Rob, Mark and Di. Rob, Mark and Di. And then we're also going to need their current accounts. Again for Rob, Mark, Di. Rob, Mark and Di. So initially then we need to put the opening balances in. So for the capital accounts then, so balance brought down. So for Rob it's 65,000, for Mark it's 55,000 and Di is 40,000. In terms of their current accounts, so again the balance brought down is going to be 8,000, 5,000 and 2,000. So step 1 of our transactions then is to clear out Rob's current account to his capital account to reflect the fact that he's retiring. So we're going to make a transfer to the capital account of Rob, and we're going to take 8,000 out of Rob's current account. So Rob's current account is now cleared, and we're going to transfer it to his capital account so that we're just dealing with the one account for the retirement of Rob. So the next thing that we need to do then is to use our goodwill to create that and reward the partners in their current profit sharing ratio of 3:1 for the creation of the goodwill, which was agreed as being valued at 60,000. So into the capital accounts we're going to split 60,000 goodwill. So 3:1, so Rob's going to get 30,000, Mark's going to get 20,000 and Di 10,000, splitting the goodwill in their equal parts according to their profit share ratio. So now we've got that position. The next step then is we need to start removing Rob from the accounts. So it says that Rob is to get paid 20,000 of what is owed to him, and the rest will be left as a loan in the accounts. So as far as Rob's concerned then, so we're going to need to total up his account. So he currently has a total of 103,000. So over on the other side then, so Rob's account will equal 103 on the debit side, of which we're going to pay him from the bank 20,000, and the remainder 83,000 will be transferred to a loan liability account to reflect the fact that Rob is still owed some more money. So the final step then now is to actually remove the goodwill from the accounts and to remove it in the proportion of the new profit share ratio. So this is going to be 2 parts to Mark, 1 part to Di. So So in terms of my goodwill then, so we're going to clear the goodwill with an entry to the capital accounts of 60,000, remembering that we're going to take it back out in the new profit share ratio. So goodwill, so we need to remove 60,000 in a 2-to-1 share. So Mark is going to get 2 parts of 3, so he's going to get 40,000, and Di is to receive 1/3, so 20,000. Now we're in a position whereby we can also then balance off Mark and Di's accounts. So that's 75,000 total credits, so 75,000 for total debits, giving Mark a balance to carry down of 35,000. And then with Di, she's got 50,000. Total up the debits, make it equal 50. So Di is going to have a carry down balance of 30,000. And so that will be us able to carry on accounting for this partnership tomorrow with the new structure. So the final step in partnership accounting then is to actually prepare the financial statements for the partnership. So in terms of the double entry, apart from that deals with the capital accounts and the current accounts, all the other transactions will be exactly the same as what you covered previously this term and last term. So all the double entries exactly the same for bringing in inventory, doing the closing balances, depreciation, etc. So before you reach your second session this week, can you please make sure that you've had a look at the question over the page dealing with the ABC partnership. There is no change in the structure, so it is just basically a exercise in doing a set of partnership accounts. So if you noticed, you're asked to draw up an initial trial balance, prepare the statement of profit or loss, prepare the appropriation account, so how do we split that profit or loss between the partners in accordance with their profit share ratio. We also then prepare the current accounts, that's going to include their salaries, their interest and profit share and drawings, and then finally a statement of financial position. So the answers to ABC will be placed on Moodle for you to be able to check, and if you've got any queries, your lecturer will be dealing with it in brief as part of the session 2 this week.